Okay, so I hope you liked my Ticker Pro review. Today I'm going to review Simply Wall Street, which is another tool that I've been using. I'm a pro subscriber or a premium subscriber for Simply Wall Street. Been using it for a while, and something that I like to touch on today is the screener. I like to talk about the Discover option and also the portfolios. So without further ado, let's dive into it. Okay, so when it comes to the screener, I think this is one of the most powerful tools in Simply Wall Street. You can have your own safe screeners. The good thing about this screener in comparison to the Ticker Pro screener is that this is much more visual. Ticker Pro in general, one of the biggest differences between these two tools, Ticker Pro is a hard code data, right? So Simply Wall Street is much more, the UI is much more visual, much more user friendly, and it's actually very pleasant to use. So if I go to my value screener, I have a value screener which I have defined with different filters that I'm interested on. One of the main differences that you can see here in relation to Ticker is that even the filters, the amount of filters, the number of filters that you can see in this screener is much lower than the number of filters that you can see in Ticker. The tool itself, I can see different type of users. I can see Ticker user, a much more advanced user that knows very well what they're looking for, and the Simply Wall Street probably more starting intermediate type of user. So let's take a look at the filters. The first one is the market cap. I like companies with at least 5 billion market cap. Valuation, we will get into the valuation in a minute, but the valuation is an interesting one. It uses analysts data, so you have to take it with a pinch of salt to estimate future growth. So what I like to do, well, take a look at the valuation later on, but what I like to do is take a look at the valuation here to filter some companies and then do my own valuation of those companies, because as you will see later on, you can't play around with the data, and the valuations can be, you have to take it with a pinch of salt. So I like to have a P ratio of between 0 and 23, maximum 23. This can vary per industry or per company. Companies with a very optimistic and huge growth, you're expected to be able to pay a premium for those companies, but in general between 0 and 23. Future growth estimate, return on equity, I like it to be between or at least 11%. That's the use of that the company makes of the resources, the equity that is at their disposal. So at least 11% for the last 3 years. As you can see here, the filters are very, you can't really do much beyond what is here, right? You can see 1, 3 year, but maybe I like to see companies that have a return on equity of more than 11% for the last 10 years, for instance. You can't do that here, right? So this is, flexibility is something that it lacks. The filters are much more flexible in Ticker Pro. So this is why I'm saying that Ticker Pro is probably more for the advanced user that knows very well, wants to go very fine-grained on what they're looking for. In terms of past performance, this is something I like as well. I like to see companies between a past 5-year earning growth between 0 and 19%. So at least I want to see companies that are growing steadily. Again, it's tricky because you can have companies that are very strong and are growing very fast, but they can have a bad year. An example would be, the pandemic. You can see a lot of companies that had negative growth during the pandemic, but it doesn't mean that they are bad businesses, right? So it's just that there was a bad year. Take this one carefully. The return on equity ratio as well. Debt to equity, I like companies with a good financial situation, so no more than 50% debt to equity ratio. So that's the debt in relation to the equity, which is, as you know, the difference between the assets and the liabilities. So maximum 50%, and that's what I like to see. And that's it. no more filters. So if you saw my ticker video, you had like more than 300 filters. Here you have barely, how many, 20, 30, 40, and that's pretty much it. So it's good for a first scan, but if you want to have something more, you want to do something more sophisticated, you probably want to, it's probably not enough for you. So let's take a look at the company. Something that I like is this snowflake diagram. You can actually filter by, you can play around with it and say, okay, I want companies with a high growth, or future growth, good future growth, and good value. So yeah, it's visual, it's nice. Obviously the number of results is influenced by the companies that I already have, but yeah, it's something that you can play around with very visually. So out of these 5 variables, I'm usually interested on the value, not so much the future, because these are analyst estimates, and again, they are what they are. The past performance, the health, and I'm not a dividend person, but if you're a dividend person, that's something that you can take advantage of. So out of this, let's take a look at one of them, Intel. I hold Intel in my portfolio. I have a small proportion of my portfolio in Intel. I think it's a strong company. Let's take a look at the valuation first, because it's one of the most interesting features in, I think, the valuable features in the Simply Wall Street app. And it says that the company is undervalued by 33%. It gives a fair value of $84. So let's take a look at the data. You can actually take a look at how the calculation is made. So it uses a valuation model of free cash flow, discounted free cash flow, two-stage, which means that it estimates the next 10 years of free cash flow, being the first 5 years of more aggressive flow or growth than the last 5 years. So that's why it's called two-stage. First stage of high growth and a second stage of decline, right? That's what happens normally for companies. They have a stage of growth, and then after a period of time, they start to decline. A discount rate of 7.2%. To me, this is not enough. I usually go for at least 10% because I like to be optimistic. This is the return that you're expected to get out of the investment, and 7%. I'd rather go to an index fund for this, right? So yeah, this is going to influence the fair value. It's going to give a higher valuation, leaving more companies getting into the filter that you set in terms of value. And the growth rate, there's a perpetual growth rate, but there is a growth rate. This is just the calculation of the discount rate. Not so much interested. And this is actually the discounted cash flow model. The growth rate is actually the calculation taken out of the estimates growth rate. So for the first 5 years, you can't really see the percentage, but you can see the percentage for the next 5 years, which is, as we said, declining after the 5th year, from 8 to 6 to 5 to 4 to 3%, 3%. So yeah, it's the second stage where the company the growth starts to decline. And as we said before, 7.2% discount rate for the calculation, which is, again, I would go for at least 10%. This is nice. Something I don't like is the fact that you can't play around with the numbers. I think it would be super powerful if you could actually, and it's not difficult to implement, I guess, but if you could actually go here and say, okay, I want to try this with a 10% discounted cash flow and with my own estimates rather than the analysts. That would be nice. So the final calculation is the terminal value, but plus the present value, which accounts for a market cap estimated of 300,000, and then you have to divide that by the number of shares, and that will give you the fair value of the valuation of the stock, which is 84%. And that will give you an undervalue of 33% in relation to the stock price today. So if I compare this to my own valuation of Intel, I normally do, and let me know in the comments if you want to see my valuation of Intel, and also subscribe if you like the video, and please press the like button. That will help a lot to promote the videos here and do more content for you. So my own calculation of Intel goes from a 1% growth rate to a 5% growth rate, and the most optimistic evaluation was $100, then 62, 65, and 62. So I normally go at least I normally invest in a company that whose price is below my worst valuation. So I would normally invest in Intel if it's below 62. I was invested when it was below 62. I think now the price is it's 55. Actually, it's lower, still lower. So I think it's a decent price. There's not a huge margin of safety in comparison to even my own valuations. There's a much higher margin of safety in the valuation here from Simply Wall Street. But yeah, I recommend that you do your own valuation. So in terms of the rest of the features, past performance. This is the earnings history. Something that I like from Ticker more than from Simply Wall Street is that you can look at the data, and that's the real value of Ticker. You can look at the data, the hardcore data for the last 10, 15 years, wherever is there for the company, which is not something that you can see here. This is much more pre-built, pre-cooked for you. Again, it's more for I would say, even as an advanced user, I would use this more for a first scan of the companies. I would go probably here and see very visually what are the competitors as well. Something that I didn't mention is the competitors, but in the company overview you can see the competitors of the company, which is nice to see. And you can go in each valuation. I go to at least one or two competitors and compare them to the company I'm interested in. So I would go to Broadcom or to Qualcomm and compare them to Intel, and that's something that you can see here very easily. So I was saying in terms of past performance, there's you can see, the way it's visualized is not as nice as Ticker, because in Ticker you can actually click on one of the lines in terms of, for example, revenue, and that will plot a chart, and you can compare, if you saw my Ticker review, you can compare different companies for each of the metrics, for example, in terms of net income, in terms of debt, in terms of revenue, and that's actually quite nice, and I think is valuable from Ticker, and you don't have that here. Everything is much more pre-cooked, pre-built, less flexibility here than in Ticker. So let's go to the return on equity. The return on equity is considered high, and it's actually compared to the industry, which is quite nice, 23% comparison to 16% from the same industry. And something I like as well is the liabilities, short-term and long-term. What I like to see in companies is that they have the short-term liabilities, or the liabilities that they can realize in the next 12 months. They are higher than the short-term assets. They are higher than the long-term liabilities, which is something that is happening here with Intel. The short-term liability assets that they can realize in the next 12 months are higher than the long-term liabilities, which is something that I look for in every company I invest in. So you can see the breakdown by type of asset and liability, which is nice to see as well. Dividend, again, not very much interested in that because I'm not a dividend person. Something I like to see as well is the management team. I like to analyze who's the CEO, what is their background, and what they want to do with the company, and the ownership. This is quite nice, and you can see that very good sign from Intel. There is shares being acquired by the in this case by individuals. It doesn't tell you whether they are insiders or not, but it's good. It's a good sign that this is shares are being bought. Trading volume is Intel Corporation insiders have bought more shares than they sold in the past 3 months. So they are actually insiders. So this is great to see. There's one reason why insiders buy stock, and this is because they think it's going to go up. And there's multiple reasons why insiders sell stock. It could be that they think that it's going to go down, but it could be that they need money, that they are going to leave the company. There could be multiple reasons why they share. So why they sell. Shares being sold is not a good indicator of anything. However, shares being bought is usually a good indicator, especially by insiders. Recent insider transactions: October, January 26. This is 2021, but in the last 3 months there's been insider activity in terms of buying shares, which is really good. So that's it for the at least what I'm interested in from the value from the company perspective, from the company overview perspective. So again, the screener, discover are very good features. You can create watch lists and portfolios. If I go to some portfolios that I created here, what I normally do is I add, when I see a business that I like, I add it to the watch list, and I set you can set your own valuation. Here I set a valuation for some of them. For example, for Applied Materials, my valuation is $110. So that's something that you can do here. And once you are happy with the review, once I'm happy with the review, I move this to a portfolio. And you can do here, move to portfolio, and I have several portfolios that I watch, companies that are undervalued, companies that are overvalued, my general watch list, and my own portfolio. And yeah, what do you think about Simply Wall Street? Do you like the tool? Do you think it's better than Ticker? Do you know any other tools that are good and we should be aware of? So let me know in the comments. Again, subscribe and like if you like the video, and see you in the next video. Thank you very much.